think we've had another tremendous operating performance. If you look at both the South African and the Spanish portfolios, really delivering excellent results. And I think the one key message that I think is very important is when you sort of stop and look at what Vukile has produced over the last 5 years in terms of operating metrics, they've been exceptionally strong. I think it's fair to say they've been market leading, certainly in Spain and here, at the very top of the class as well. And that's been done in an environment that's been really very challenging. No economic growth. You've had COVID, you've had riots, you've had a lot of, macro uncertainty, high interest rates, etc. And now all of a sudden we're starting to see that those headwinds are turning into tailwinds. So interest rates are coming down. Certainly macroeconomic picture here is starting to look better. The macro picture in Spain is looking exceptionally strong. And I guess that's giving us a tremendous optimism going forward, because if you've now got the very strong operating platform that's delivering such strong results, together with a healthy macro environment and some good tailwinds, I think that sets things up for a sort of very good picture going forward. So certainly, at the high level, we're very comfortably on track to meet our guidance for this current financial year. And I think we are looking forward to a good FY26 as well, based on what we're seeing. If you look at the SA business, retail NOI growth of 4.6%, very healthy. Trading density growth of 4.2%, I think, is the strongest print in a few years. So you're starting to see that coming through on the ground. Vacancies remain very low at 1.9%. On that, a big story is Mall of Mthatha, which is the acquisition we made, which came in beginning of April, beginning of the financial year. That we bought with a vacancy of about 16%. That's already down to 8%. And with all the deals that are currently being signed, I think that's going to be as low as 2 to 3% early in the new calendar year. So that's been a tremendous performance. What's been a real highlight in the SA portfolio has been the ongoing work in PV. So we've really increased the capacity in this past 6 months, and there's more coming in the next 6 months. And what that's doing is driving our cost to income ratio down. So that's now at 15%, which is the lowest it's been in a decade. As much as there is a tremendous growth on the top line, and growing rentals, is equally a very strong focus on managing costs and establishing a healthy margin. Very upbeat about the SA environment, and we expect to see a strong second half coming through from the business. Castellana continues to do exceptionally well. This is a year when maybe growth will be a little bit slower. You've got growth here of 2.1%, and that's really because there are 3 shopping centres that are currently undergoing major work. So you'll see that growth coming through in 26. We're making tremendous progress on the 3 projects at El Faro, Velsur, and Los Arcos. So you'll see sort of really the impact of that in the next financial year as those rents come in. But you've got a portfolio with pretty much 99% occupancy. We definitely still feel that we are under-rented. You're seeing very strong reversions, coming through in that portfolio. And importantly, we've got the lowest occupancy cost ratio in the market at 9.5%. So there is definitely, upward potential on rentals in Castellana, and I think that same point, by the way, applies in the SA portfolio as well. So we think sort of, there's very good runway in terms of sustained growth in rentals going forward, because both portfolios are under-rented. What's been an equally strong story in the past 6 months has been the corporate activity. Let's start with obviously a key piece of news, which I think you've all reported on, is the sale of La España, where we've signed an irrevocable. That happened after this 6-month reporting period. That was done in October. And really, that's been a phenomenal investment for us. We invested 130 million euros. We've received 108 million euros over the period. So that will be 200 million will be the net proceeds that will come in. So that will be sort of a 70 million capital appreciation over the period. That and in addition, we've received 38 million euros of dividends. So we've made an IRR on this investment of around 40% in euros, which is just exceptional. We've been working flat out on for the last few months on buying a tremendous shopping centre called Bonaire in Valencia. Unfortunately, we were literally a couple of days away from signing the agreements to buy the centre, and the flooding happened in Valencia, and therefore we had to put the deal on hold while we sort of understood the impact on the centre and what's happening there. What we've done is extended the exclusivity that we currently have on the deal while this is all being done and so on. So where I think we're sort of almost trying to time it from one day to the next, there might be a little bit of a hiatus between the two, but we remain very positive about that acquisition. Another big story on the deal front has been our entry into Portugal, which also happened post-period, that I think closed on the 1st of October. Very excited about our entry there. We bought 3 centres for 176 million, 2 in Lisbon, 1 just outside of Porto. We've bought them on a transaction yield of 9% Cash on cash, we're going to be earning over 10% on those deals. So tremendously accretive and very exciting assets. They are all, sort of nodally dominant assets, 98% occupancy, trade exceptionally well, very good footfall. We're looking at 3 markets: South Africa, Spain, Portugal. We see a lot of runway, certainly in Spain and Portugal, in terms of deals that can be done. Obviously, what's exciting is that the sector is back in favour. I think we're starting to see, more and more of the generalists allocating money to the sector. That means that there is capital available. We are very, very positive about our business. We're very excited. We do see ongoing growth in the business, and that's beyond FY25, but certainly into the subsequent years. Operationally, everything on track. Clear idea of what deals need to be done. Good track record in allocating capital, and now finally a bit of help from tailwinds and markets having woken up a bit.